Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and I'm joined by my co-host,
Andrew. Bills, we are back again for another podcast this afternoon. Normally we record them in the mornings, but we're doing an afternoon session today.
This is true, and we've had a bit of coffee, so hopefully this will help us get up and around. And no, actually, this is going to be a really juicy topic for our listeners and our viewers as well too. Something that's quite relevant and timely at the moment. So yeah, I reckon that there's a fair bit of value packed into this one. So let's get onto it.
Yeah, something we're hearing a lot about at the moment. Like it's a common question. It's something that we're getting all of the time. I think it's something that, you know, if you're thinking about things, if you're thinking about finances, it's certainly on your mind at this point.
It's one of those things. I had this conversation with someone literally last week.
Yeah,
and it's something that we haven't needed to address for a while because of the low interest rate environment. But now it seems like every client, we're having the same conversation with everyone. So Andrew, tell us, what are we talking to everybody about today?
Yeah, after we've been dancing around the edges without saying what we're talking about, even though it's in the heading of everyone that's listening or watching this podcast.
The show notes as well. Yep.
Yeah, exactly. Yep. We're talking all about what should you be doing? Should I pay down my mortgage or should I be putting money towards investments? What's the best strategy? You know, is what I have been doing in the past still appropriate? Do things change now? What should I be doing in regards to the surplus cash flow that I have?
Used to be a really simple answer when interest rates were low and investment markets were increasing. But now obviously things have changed and it's different.
Yeah.
And I don't want to say it depends on your circumstances really early on, but that's actually what we're going to try and address for everybody and talk through, I guess, some of the common thinking that we go through when we're having this conversation with clients, and what are some of the trade-offs and what are some of the things that we're looking at when we're advising people about whether they should go in one particular direction or not.
Yeah, exactly. So take us through it, Bills. What do I do?
It depends on your circumstances. But look, I guess let's get this clear in terms of what are we actually talking about, because there is a difference from a taxation perspective around owner-occupier debt and an owner-occupier mortgage versus an investment debt or an investment mortgage. So in this instance, we're really comparing and contrasting if you've got an owner-occupier debt, paying that down, I guess, above and beyond your contracted repayments, versus putting additional money into an investment.
Yeah, exactly.
Just to clarify, I think that's probably the best starting point.
Yeah, well, I mean, look, it definitely changes the situation. If you're talking about deductible debt, then obviously, you know, even though it's still an expense, and so important thing to note, you know, a deduction doesn't mean that you get all of the money back, but it's a different kind of calculation. It's a different thought process when you're talking about deductible debt as opposed to non-deductible debt. So yeah, really, really important thing to call out and to, you know, look at when you're making a decision on all of this.
Yeah. After tax rate of return is probably the biggest thing that we think about and we talk about to people. Above and beyond that, the sleep test, I mean, these are all the things that we'll get into. But the question goes something along the lines of this: my interest rate has now gone up to X. Let's pick a figure. Let's go with 5%.
Yep.
So I know as a client that I can get 5% after tax rate of return, rain, hail or shine, versus potentially putting it into another investment, not knowing what the outcome is going to be, whether or not I'm going to get a greater return of one versus the other. But in volatile markets as well too, I may actually go backwards for a period of time.
Yeah. And then the other thing is the tax element to it as well. If you're generating a rate of return of, you know, 8%, but you're paying, you know, a third of it in tax, and the tax element is stripping it out, then your after tax rate of return is actually a little bit lower, depending on what sort of, taxable income bracket you're at. So looking at, what I'm actually going to get at the end of the day, rather than just, headline numbers, 5%, 10%, 6%, whatever it is a really important aspect to all of this. I mean, I think that it's way too simplistic to just look at, what's one versus the other, but it's an environment where interest rates are increasing. So mortgage holders are really feeling the pressure from a cash flow perspective. And in addition to that, at the very same time, you're experiencing huge volatility in markets. So all of a sudden, you've now got a scenario whereby 6 months ago, or probably a little bit longer than 6 months ago, maybe 12 months ago, the answer was a little bit more simple, and people were more open towards putting money towards investments, whereas all of a sudden it's really shifting in the other direction.
And look, there's nothing wrong with that. And one of the things that I guess we talk to people about all of the time is whatever strategy you're using and whatever strategy you're deploying, you have to feel comfortable with it. And I don't know about you, but when we're talking to people, the additional repayment on their mortgage, knowing that you're going to reduce it pound for pound, you know exactly what your return is going to be. Now, not necessarily from an investment perspective, but if you put $1 extra in, it's going to be $1 plus the interest and stuff, but you know that that's what you're getting. Whereas you might put $5,000 in the share market, and if it loses, 10%, you're down to $4,500.
And you've also missed out on the interest. So you've also missed out on the opportunity cost of putting that towards your mortgage. So you're probably another 5% above that if your mortgage rate's at 5%.
So there's this emotional element to it as well that people have got a really good understanding about. If I put it into my mortgage, I know what I'm going to get. Hence the sleep test that we call it. And regardless of what strategy you deploy, you need to feel comfortable with what you've got. We're seeing that a lot, just pivoting for a sec, but we're seeing that a lot with our elderly clients, especially those who are retired. We're starting to have conversations around fixed interest products with things like term deposits. Well, we were never having that conversation, that long ago in the past.
Yeah.
Just because it makes them feel, more comfortable, they understand it, and it helps them sleep better. And ultimately, I think considering with a mortgage, considering it's around for such a long period of time, you need to feel comfortable with the position that you're in.
Yeah. And I think the rise of, offset accounts, and I feel like every mortgage these days has an offset account. So your ability to, put it in, but then still be able to draw that money back as well makes things a lot more, palatable for people that, hey, I can make additional mortgage repayments because it's still there. I've still got access to it, and I'm not paying it into the loan and having to refinance in order to draw that equity out at a future point in time. So yeah, there's definitely a case, especially in an environment where interest rates are rising, there's definitely a case for putting additional funds towards your mortgage.
Yeah. And that's something else that we talk to clients about when we're going through this decision-making process. It's not just, hey, your rate of return on investment. It's not just the sleep test. We take other things into consideration, like your liquidity.
Yep.
So in the event where we were suggesting, in the past, maybe it's better off to invest it. Yes, it's still liquid to a certain extent. You can liquidate the fund. You can get some money out. Away you go. If you're making additional repayments to your mortgage, even if it is in the mortgage or putting extra into the offset account, you should still have that money available to take back out if you need it, even if you do pay it into the loan in the form of redraw as well. So liquidity becomes a big thing as well for clients when we're having this conversation. So it's not just the rate of return, it's making sure that you're not leaving yourself short as well in case you need some extra money for emergencies or whatever it may be.
Yeah, exactly right. And look, when you are on the, on the conversation around liquidity and what the future use of the funds is, that's a really important consideration, because if you're putting a lump sum amount of money in, you think, I've got a bonus. What are you expecting to do with this? Are you going to need to pay tax debt come 1st of July next year, and you're going to have to liquidate the funds at some point in time anyway? And so, perhaps in a scenario like that, you want to park it in something that's risk-free as opposed to putting it in the market while things are quite volatile. Is this a long-term investment? Is this something that you're going to hold for the next 20, 30, 40 years? Are you going to, need to pay for a wedding or a, large planned expense that that you're going to have to draw it out? And so in those instances, a lot of the times you're actually better off putting it into something where you're not risking any of the capital and you are getting a guaranteed rate of return out of it at the end of the day.
A lot of stuff to think about.
Yeah, absolutely.
How do we structure these conversations with people when we're having this? Because obviously it's all of that combined, but then how do we move it from that to, okay, this is what you should do?
So the way that you move it to this is what you should be doing is look at your long-term plan. You have to consider what are you doing in the long term, because at the end of the day, if you're making mortgage repayments or additional, debt repayments, if you're investing in the market, the thing that I like to make really clear at the very beginning is there is no right and wrong. Like there's no strategy where you're doing the wrong thing because you're taking action forward. What you're looking at is what is the most opportune use of your funds. You're not doing something that's going to put you, or hopefully not going to put you in a negative position, provided that you're making smart and rational decisions. So what you first do is look at, all right, where do I actually want to get to? If you've got a mortgage and that's sitting against your owner-occupied property, making additional mortgage repayments is great, no doubt. But what's your long-term plan? How are you planning on retiring? Because if you're not planning on, being an employee, getting paid superannuation, pulling those funds out at the time of retirement in a, account-based pension and working up until the age of 65 or whenever you meet a condition of release, if you're not planning on doing that, eventually at some point in time, you're going to have to get into some form of investment strategy. You're going to pay off your mortgage and you're going to need to look at what's next. Sometimes it's difficult to get yourself mentally out of paying down debt. And so what a lot of people do in that scenario is just, okay, well, I'm going to take on another debt. I'm going to buy another property and just pay that down. And that's it, without actually using any thought, any methodology towards, is that actually the best use of my funds? So once you start to take a step back, look at things from a long-term perspective, that's when you can start to say, okay, I'm going to make additional debt repayments, but I'm only going to make additional debt repayments with, 30% of my surplus income, and the remaining 66% I'm going to put towards X, Y, Z. Looking at the long-term time horizon, looking at the overall picture, that's how you start to formulate an exact strategy on how to move forward.
Yeah, so the way that we think about it with financial planning, and a very, very thorough summary, is working out the future state and then reverse engineering it. So putting some numbers around this, let's just say we're dealing with, the 40-year-old, and they've got an investment time frame of 20 years. We might turn around and say, okay, your 30-year mortgage that you've taken out today, rather than paying it off with all of your surplus money and you'll pay it off in 12 years, let's calculate what that repayment schedule needs to look like in order to pay it off in 20 years to meet your 20-year time frame. And then what you've got as surplus above and beyond that number, that then goes to something else, whether it be an additional investment, whether it be salary sacrificing, whether it be buying another investment property, whatever it may be, because that way you're then matching the activity and the effort that you're putting in now to the goal and the time frame that you've set for yourself.
Yeah, exactly right. Exactly right. So in this environment, interest rates are rising, volatility in the market, we shouldn't be taking on any more debt then, should we?
See how Andrew threw that question over to me?
Yeah, exactly right. If I ask the question first, then you have to answer it.
It depends on the client circumstances. There's different strategies, there's different positions. And once again, yes, we're dealing with larger amounts of interest that we're paying. So cash flow, security of income, liquidity, all of those things are now, not that they weren't critically important before, but they're very, very important, and you need to know your numbers. So if you're in a position, and once again, it depends on your risk appetite and what you think the future is going to hold as well too. And what I mean by that is if you're in a very strong position financially and you're comfortable with the level of debt that you need to take on in order to purchase a property as an example, if you're comfortable, you've got great cash reserves, you've got great security of income, you may actually look at this environment and say, hey, it actually represents a buying opportunity for me because it's a buyer's market. So once again, that's sort of one side of the spectrum versus somebody else that might be really, I shouldn't say paralyzed by it, but looking at this thing going, hey, the Reserve Bank are putting up interest rates 25 basis points, 50 basis points every time they meet. Before I know it, my cash flow or my spare surplus is going to be eroded because I don't have a lot of room to move. Completely different story.
Yeah.
So I don't think there's a straightforward answer to your question. But if you're in one category versus the other, I think it not necessarily the answer is clear, but your options, whether you go or whether you don't, is a decision to be made versus if you're not up against the wall, but if you're a little bit tighter with those things, then you can't be taking on any more debt in an environment where interest rates are going up. You probably need to play a bit more of a defensive strategy and look at what can I do in the event that the environment continues going the way that it is. Do I need to do anything different than what I'm doing?
Yeah.
As opposed to just, I don't know, maybe sitting there and hoping that the Reserve Bank are not going to move again when they meet in December.
Yeah, exactly. I mean, look, I don't know, sitting there and hoping that the Reserve Bank isn't going to move. Who knows what's going to happen, in December. I mean, the market's already obviously pricing in future interest rate rises, but, sitting there and hoping for that not to happen is, I think, a bit of a futile strategy. So making sure that you've got, the right structure around your cash flow, around your budgeting, around your debt position, making sure that when you do go into debt, that you're doing it in conservative and in a conservative manner that's going to be manageable as well. If the proverbial, I was going to swear on a podcast, but something were to hit the fan, were to happen, you want to make sure that there's buffers in place in essence. The other thing to consider, which we've alluded to and spoken about, but not really addressed specifically, is your risk tolerance. A guaranteed rate of return by putting funds against a mortgage or against an offset is the lowest risk essentially that you can take. Now, if you're someone that can't sleep at night or you don't have the tolerance to risk, then you need to invest in a more conservative manner, or alternatively, you need to educate yourself and slowly but surely over time get used to investing in more riskier or volatile assets. So what I mean by that is maybe the strategy for you is, rather than the perfect financial scenario, when you work out the long-term plan, is you invest, I don't know, I'm just using random numbers here, but you invest 50% towards your mortgage and 50% towards more volatile assets. Okay, well, your risk tolerance doesn't necessarily allow for that. So let's flip it and say, all right, we're going to do 75% and 25%. So what I'm trying to say is you don't need to choose one or the other. And in actuality, you probably shouldn't be choosing one or the other. What you're doing is varying what proportion is going to be put towards, one decision versus another decision, as opposed to just choosing one camp and going with that.
Yeah, I mean, my own personal preference is within your confines and within your own personal circumstances is you do a bit of everything.
Yeah.
But I think overarching with all of it, yes, you do a bit of everything. That makes sense. That makes me feel comfortable as an individual. Different when we're giving advice because it's tied to the client's situation. But you need to be in a position where not only to make the decision whether do I put more money into my mortgage versus do I put more money into the investment or change the balance. I think that's critical. But I think what's even more critical is making sure that fundamentally you've got the right things in place first. And what I mean by that is, say, cash flow management. If you don't have a good cash flow management system, whether you change your percentages and rather than going 50-50, you go 75-25 or 100% extra into your mortgage and not invest anywhere else. If you don't have a good cash flow management system, you're always going to get, I won't say unstuck, but you're always going to feel uneasy about the environment that you're in.
Yeah.
So coming back to the fundamental basics that we talk to people about around money management, liquidity, risk tolerance, your plan B with insurances, all of those things are relevant. Getting those things sorted, it's like building a house, making sure your foundations are sound, because no matter how good your structure is and how good your strategy is, if your foundations aren't sound, then you're always going to be on shaky ground.
Yeah.
So I think coming back to, without needing to pivot into something else, if you've got your fundamentals right, that decision becomes a lot easier because you don't have to worry about the other stuff.
Yeah. Another really important aspect and another, kind of massive thing in all of this, which I find is, look, it's relevant to almost everyone, but more relevant especially towards, the younger wealth accumulator clients, is long term, the investment rate of return or the rate of return that you could have gotten in investment markets outstrips what you can get as a mortgage interest rate. It doesn't feel like it at the moment because obviously there's some volatility with investment markets. There's talk about interest rates rising. And so psychologically, maybe it's a different feeling now. But long term, if history is anything to go by, investment markets overperform what you're going to get from a bank savings rate or a mortgage offset rate. So provided that you're playing the long-term game, again, you can swing too far in the other direction and not make any additional mortgage repayments, put everything onto investment markets, and you find yourself in hot water if things are to turn. But long term, your strategy still has to be towards investments, provided that you've got the time frame for investment. That's ultimately what's going to yield you the greatest rate of return or the greatest opportunity for wealth creation.
Yeah. Come back to your time frame, come back to your investment strategy. What does that look like? Yeah. And I guess it's always one of those things that we talk to clients about. You hear the old adage, turn down the noise and think long term and stuff. I mean, that's right. If you project yourself forward in 20 years' time and say, hey, I wish I did this, I wish I did that. If you're looking at it from your future self and you make some assumptions because the data shows that economies continue to grow, GDP increases, asset prices go up, it's healthy to look at it from a helicopter view or a long-term perspective, because that helps you, I guess, put things into a context where you're not making short-term decisions when they should be long-term decisions, and it helps remove a lot of the emotion out of it, because we've got to be realistic. We are going to experience volatility.
Yeah.
But once again, that comes down to the sleep test, feeling comfortable with what you're doing today, making sure that you're making the right moves to not only set yourself up for tomorrow, but to make sure you're feeling comfortable enough today so you can sleep and it's not keeping you up at night.
Yeah, exactly right. Well, Bills, I think that summarizes it quite well in terms of, what you should be doing. I don't know whether
I don't think we landed on it, did we? Did we land on it?
Look, I think in everything, it's
never straightforward, is it?
It's in finance, it's a little bit of, what you're comfortable with. It's a little bit about, what your personal circumstances are, and it's a little bit about receive financial advice so that you've got an unbiased viewpoint when you're making a decision. You really need to take everything into consideration, and there's no one size that fits all.
Yep. Andrew, well said, well summarized. And to our viewers and our listeners, thank you for your time. If you want any more information, details are in the show notes. Be more than happy to have a chat, and we'll catch you on the next one.
Thanks again. Look forward to seeing you on the next podcast.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.